Hello and welcome back to the ROI channel, the channel that is obsessed with all things return on investment. Today we're going to talk about one of our biggest positions in the Crassus fund, which has come about due to a recent opportunity in global markets, which we'll talk about today, which is the sell-off in Chinese tech stocks. And today the focus is going to be on Alibaba, which is an incredible business, not an easy business to understand. People think of Alibaba just as a sort of a wholesale platform, kind of like Amazon, but it's so much more than that, from fintech to payment processing to cloud storage, which is one of the key areas in which it can grow, particularly in China over the next decade. So if you haven't already subscribed to the channel, I encourage you to do so that you can keep up to date with our analyses and progress. And if you haven't checked out the fund on eToro, download the app and there'll be a link in the description. If you wish to copy the portfolio, we'll show you how to do so. So before we get into it, let's recap our investment formula. So we're looking for companies with low debt, and why is that important? I'll quickly touch on that. In the capital stack of a publicly traded business, debt holders or bond holders are higher up the hierarchy. Okay, so if you lend money to a company at a fixed interest, that'd be a corporate bond, then if something really bad happens to the company, let's say, and they have to liquidate, when they're selling off the assets of the company, winding it up, the senior debt holders, the bond holders, get paid out first, and it goes through a hierarchy all the way down to us as the shareholders. So we're not a bond holder of Alibaba or any of these particular investments that I talk about on the channel. We're simply buying the fractional ownership in the business, the equity holders. So we're right down the bottom, which is why having low debt is extremely important. We want a margin of safety for obvious reasons. In terms of the business operations, we want to see sales growth, which you'll see Alibaba's sales growth are phenomenal, strong margins, free cash flow growth. So how much of the profits are actually freed up and can be used to either give back to the shareholders via dividends, share buybacks, or can the company buy out and acquire other businesses to continue to increase the cash flows of the operation? And ideally, if we can get share buybacks, that's the holy trinity. Okay, if you've got revenue growth, strong margins of free cash flow growth, and they're buying back their own shares, our profits are going to increase over time, and that's a good use of capital. So let me get out of the way there, somewhere down here. China's, as everybody knows, is an economic miracle. Okay, so if we look at back here, 1989, after Mao Zedong, basically the whole communist regime didn't quite work out as planned. Funny that. There was a man called Deng Xiaoping, and Deng Xiaoping knew, okay, look, we can call ourselves communists as the party and have total control, but we kind of need to look at what's actually working in the world. And they used Lee Kuan Yew, who was the leader of Singapore at the time, and has obviously had a phenomenal track record in Singapore. They said, what if we took parts of this capitalism thing and we allowed citizens to operate in this very unique blend of communism at the top and capitalism down there at the bottom and in the middle? And the results, as we know, have been phenomenal. Chinese GDP, the sales of everything produced that is Chinese, and the overall growth in the nation's economy has been staggering, nothing short of a miracle. And so if we look at the trajectory of China, and then around about here, 2000, 2001 would be about there, when China joined the World Trade Organization, and things just went ballistic. Okay, in China, they became known as the world's low-cost producer. So companies said China's the place to be if we want stuff made, because they can do it so cheaply. And the rest, as they say, is history. So 14 times growth over what is about 33-year period is phenomenal. If you just look at the comparisons here off to the side, you'll see China versus our benchmark, the S&P 500, the main US stock index, US debt holders, low-income countries. So it hasn't just been an emerging market thing. It's really been a Chinese phenomenon. So moving forwards, there's no doubt that this century will belong to Asia economically, and China obviously is the powerhouse. And so although there's a lot of perceived risk and real risk politically and otherwise with investing in China, funds really have to be global now. You can't just stick to your own backyard. And I think that we need to have some exposure to China. We have only about 15% exposure of the Crassus fund in China. And of that, we've been extremely selective. We picked what I believe the three best stocks in the index. And so we're going to be hopefully catching a big part of the tailwinds for Chinese growth moving forwards. All right, so the recent sell-off has provided an opportunity. This is the Shanghai Composite Index, okay? So imagine all the businesses, all the stocks listed on that exchange. That's what this particular model is tracking. And so we can see over the years, phenomenal growth, a lot of volatility, boom, after the GFC 2008, growing along, and we're here. So if we look at, we're really still above COVID levels, although recently certain stocks on the index have been sold off because large index funds like Cathie Wood's ARK Invest have sold out of Chinese tech. It's a lot of the mediocre or poor performing companies that we wouldn't invest in anyway have been sold off. And because you get this broad selling off, you get good companies being sold off with bad companies. And it's really the perfect time. If you know what you're looking for, it's a great time for value investors like ourselves. So with this recent sell-off, we'll be looking to acquire as much as we can allow in terms of allocation to China. All right, so over the 1 year, this is where we are. That's just taking a more narrow view. And as you can see over here, if you follow my cursor, this is the recent sell-off. This has been due to fears about the CCP cracking down on businesses in China. They did fine Alibaba 2.8 billion, okay, just a lazy 2.8 bill for what they called antitrust or anti-competitive practices. They've paid the fine, they've settled, they've moved on. The commies have extracted their pound of flesh. Where a lot of people are concerned here is if you have stocks like TAL, which was an education company in China, competing essentially with public education. And they were essentially advertising over here saying, our high fee tuitions are so much better than government education, even though it was the same curriculum. And the Chinese really don't like criticism of their ways, and so quite frankly, the company should have been a lot smarter in what they were doing. They also, with that sort of communist philosophy, they do not want anti-competitive practice, or what they perceive to be anti-competitive practice. Whether you agree with it or not, that's just the way that they are. And so they said, all right, you guys are in big trouble, and we're thinking about delisting you. Same with the rideshare company, DD. And so amongst all of this kind of uncertainty, there was just an ocean of large funds selling off. Now that says absolutely nothing about probably 90% of the businesses there. So if you're analyzing Chinese investments, yes, you do need to take the China factor into account, but we're going to show you how that's been done today and why there is an opportunity. So this is specifically Alibaba. So this is the shares price action over the years. Says nothing about the value. Okay, price and value, two very, very, very different things. People confuse them all the time and really don't know the difference between the two. As you can see from the highs of 319 and change, we closed yesterday at 195 and change US. Okay, so I mean, absolute crash in the price. How much has the underlying business changed? That's the key. If we have our valuations based on what we think the cash flows of the business can be moving forwards, and then we work backwards and say this is the price at which we would like to buy to get our at least 20% IRR return. How does that, if a price just moves because of other businesses that are potentially going to be delisted, then as far as we're concerned, we're able to get those shares cheaper, and so our expected returns should, if all else being equal, increase. So let's get into our narrow view of Alibaba itself as a company. So quick facts about Alibaba. the revenues are just outstanding. Okay, it's incredible. $173.5 billion sales, which have grown at 41% year on year. Will that be volatile over the next few years? And yeah, of course. But it's staggering growth. Where else can you find that growth? It's an incredible opportunity. Strong margins. EBIT there, 39 and a bit billion, 26% compounded growth rate. Fantastic. So their margins are great. Shares, return on capital investment for a company that size is reasonable. Market cap 530 billion, enterprise value 505 billion, which means the company has more cash than it does debt. Total debt to EBITDA, that's fine. We look for less than 3. If you look at a net debt basis, the company can pay out all its liabilities just with the cash on hand, which is pretty awesome. Buyback ratios, it's okay. It's been flat, but they do go through these kind of periods. They issue shares, they repurchase. Sometimes they issue more than they repurchase. Sometimes they repurchase more than they issue. But it hasn't been bad. You don't have a heap of dilution risk with this kind of company. And if you come back to the balance sheet and you look at how much cash the company has and how much cash it generates, they don't need to be issuing shares, and there's a low risk of our holdings as shareholders being diluted in the future. And that's the last closing price. Okay, so let's look over the next couple of years. The company has already made their announcements for 2021, so their fiscal year is a little different. So we're looking out to 2023 and saying, okay, if we go through 3 good indicators of the business performance, so we've got our GAAP earnings per share, free cash flows, and Ebitda. What I've done here is used the confirmed announced measurements for this year, for 2021, used then our multiples of the median of the industry and what Alibaba is currently trading. A word on this: Chinese companies have always and possibly will continue to trade at lower multiples than their US counterparts, just simply because there is that perceived risk. Okay, so we can't, in our forecast, we can't say, oh, well, the industry median, including US companies, is a lot higher. So if you look at Amazon, for example, it's I think it's 30 odd times the cash flows. We're not going to get that as shareholders of Alibaba. So we can't just automatically assume we're going to have that massive multiple expansion. We've got to be a little bit conservative, and so using historic numbers for Baba certainly makes sense. So we've got our earnings here, and applied share price. We've got our free cash flows and our Ebitda. Okay, and if we go through as an average, very conservatively, we're looking at around a 25% upside. Now through here, I should be able to show you a more in-depth analysis. So what I've done here is taken the cash flows and I've run through growth rates with different scenarios. So we've got our base case, we've got our bull case, our bear case, and I have been, as always, conservative. Then what we do is we do our discounted cash flows for each of these: base case, bull case, bear case, and down here we assign them a probability weighting. Okay, so our base case is the most likely, so we assign it a higher likelihood. I have overweighted the bear case, okay, or the pessimistic view, as a kind of a hedge. Okay, again, discount rate, I've used our required return of 20%, which is a huge hurdle. So all the cash flow streams that you see here, they have to be discounted at a factor of 20% into today's value. And we come through to the earnings, and what I've done here is I've done the same thing with the earnings and come up with an average of the free cash flow model intrinsic value and the intrinsic value that the earnings model gives us. And that tells us if we want a 20% IRR, we need to buy the shares at $4.57 or a little bit lower. With a margin of safety, we can look at about $300. Okay. Now, depending on what you use, you'll get different inputs and outputs there, obviously. In this case, that to me seemed a little bit high. Okay. In the past, my intrinsic value for Alibaba has been around $320 US dollars, that is. And so I've added an extra arm to the process, okay? And this is probably a more appropriate way to value Alibaba anyway than pure earnings, as earnings takes in a lot of other factors, okay? Depreciation and so on and so forth. So if we look at EV to EBITDA, so the enterprise value to EBITDA multiple, what would that give us, okay? So we run through the same process, which you can see here. And if we look at that, we get a $220 and a bit intrinsic value. Okay, so we want to buy at that value or below in order to get our 20% IRR. Obviously, we buy it lower, we get a higher return. And then if you take the 3 and add the intrinsic values up and get an average, so that from the free cash flow, the earnings, and the EV to EBITDA, this is what we're looking at here. So we're looking at that 220 mark in terms of a good entry price. So comfortable with that. 220 is fine. And if we are looking at 195, things seem to be pointing us all in the right direction. Okay, so quick recap. Low debt, yes, it does have. Margin of safety, yes, it does have. You know, if we take that super conservative 220 as our intrinsic value to get 20% returns long term, buying it at 195 is good. Okay, sales growth, strong margins, free cash flow growth, share buybacks, good enough. They're not diluting, but they're not like Allstate, for example, that are shrinking the share count almost like 5% year on year, but they're still pretty good. I'm definitely buying Baba, and although we don't try and time the market, I did do a pretty good job on this occasion. So we missed the bottom. If we call the bottom in, which, you know, you shouldn't do, but I'm thinking that we're pretty close to the bottom in terms of this panic sell-off. We were about 6% off the bottom, which is damn good. We'll take that any day of the week. But of course, long term, we're not interested in fluctuation. So if our holdings go down a little bit tomorrow and then come up and so on and so forth, long term, we believe strongly that we're on a winner. It's these opportunities. If we hang out and there's blood on the streets, which is a famous quote there by the big Baron Rothschild, that's the time. You don't want to be sitting around like a timid little rabbit. When you get the chance to buy a global phenomenon that is Alibaba, and you go through, or in this case, I go through, and I believe personally that Baba is an intrinsic value of 220 conservatively. If we can buy it when there's blood on the streets and the share price is at 195, to me personally, I think that's a green light. And this is actual footage of me here buying Baba, backing up the truck. If we say it's a buy, well, how much are we going to buy? We're actually going to put about 6% assets under management into Alibaba, and I've fully allocated that now. So the share price may go lower, in which case we just say, okay, that's fine. We're fully allocated. We're pretty happy. Our average entry price is, I think, about 190, just under $200 US, 199, something like that, which is great. We'll take that any day of the week. Thank you very much for watching, guys. I hope it's been useful. Again, please do your own due diligence. Read the disclaimer at the end of the video. This channel is my views and my opinions and the reasons why, but obviously you have to take charge of your own due diligence when it comes to investing. If you're interested in checking out the portfolio, head on to the link there. It'll also be in the description. You'll go across to the page on eToro. You'll see this, and there'll be a copy button around about here. If you feel like you've got the hang of the investment philosophy of the channel and you really like it, and you want to put, I think the minimum investment is $200, but if you wish to properly copy and sync the portfolio, I think it's $520 currently. Then, you know, I'd appreciate that. By all means, go for it. Thank you to everyone who's invested already. Really appreciate it. And if you want to follow me on Twitter, there's the ROI handle. And if you haven't already, please share, like, and subscribe to the videos, so it helps me to grow the audience and learn more about what you guys want to hear. Thanks very much. All the best, and have a great day. I'm going to leave it there.